So what's an ISA? Well, it basically stands for Individual Savings Account. And while that name might sound a little fancy, the actual concept of it is really easy. It's a saving or investment account that you never have to pay taxes on. So each tax year, you get what's called an ISA allowance, which sets the maximum you can actually save in this tax-free wrapper. So the question is, how much can you put in an ISA? For the current tax year, that is £20,000 per year. You can choose whether you want to invest the whole lot in one type of ISA or whether you want to split it into different types. However you choose to split it, you can't invest more than £20,000 in a year across all the different types of ISAs. The financial year for ISAs starts from the 6th of April all the way to the 5th of April the following year, and that is the end of the tax year. For it to count towards the year's tax allowance, you have to have it paid in between those two dates, and if you don't use the full 20,000 allowance, you lose it for that year. Any savings or investments which stay within the tax-free wrapper, aka the ISA, will continue to earn interest, and the interest on the interest, as in the compounded interest, is also tax-free. There are 5 key types of ISAs. There's a cash ISA, a stocks and shares ISA, lifetime ISAs, innovative finance ISAs, and junior ISAs. We'll start off with the most common, which I believe in the last statistics was around 70% of ISA holders had only one of these, and that is a cash ISA. For a cash ISA, it acts as a standard savings account. If you've got large amounts of savings, you can pay them tax-free. If you had standard savings account and you've got a large amount of cash on there, any interest that you earn over your personal savings allowances, which are £1,000 for basic taxpayers and £500 for higher tax rate payers, you'll have to pay tax on that. But with a cash ISA, you never need to pay tax on the interest. It doesn't count towards your actual allowance for the year. So let's say you've got 20,000 in there, and in the following year, you earn £1,000 of interest. That £1,000 isn't added or deducted from your next year's allowance. It allows it to accumulate. So if you earn lots of interest, you protect it more by having it within the ISA because you don't need to pay tax on it. So just like a normal savings account, there's a variety of different cash ISAs you can get, and we'll touch base on a few of them. There's the easy access cash ISA. These do what they say. It's basically you put the cash in, you can take out the cash whenever you need with no penalty. There's notice cash ISAs, where you need to give a certain number of days notice to withdraw any cash. They're best if you may need the cash, but you're happy to wait for it. Then there's fixed rate ISAs. Fixed rate tend to offer higher rates than easy access or notice ISAs, though if you do need the cash and you want to get access to it, you'll often have to pay a penalty, and this is normally in the form of an interest deduction. Then there's help to buy ISAs, which are still going on but aren't available to new applicants, so I won't go into any detail on those. But if you've got one and you want me to sort of give you any information on it, leave a comment below and we'll go into that. For all of the banks in the UK, there is savings protection, and this works the same for cash ISAs as it does normal savings accounts. So provided your money's in the UK and in a UK regulated bank or building society, accounts of up to £85,000 of it is protected under the Financial Services Compensation Scheme. Now we'll have a look at my favorite ISA, which is the Stocks and Shares ISA. It's tax-free investments. You can use your ISA allowance to actually invest in bonds and companies, the most famous of which is the S&P 500. Then you can invest in bonds, which are basically a loan to a company or the government, and you can invest in shares in individual companies too. As with investing in stocks, the prices do go up and down. In order to smooth out some of those peaks and troughs of the stocks or shares, it's always best to look at things on a slightly larger time horizon, so say 5 to 10 years. That will smooth things out. With stocks and shares ISAs, most providers will charge fees that come with it, so these are something to watch for. If you'll keep adding to your investments over a long period of time, it's best to do so within a stocks and shares ISA. The protection of the ISA wrapper is permanent. The advantage of stocks and share ISA over a non-ISA include things like exemption from capital gains tax. That is a tax on profits which you only pay when you sell your investments. Everyone gets a fairly decent decent allowance of $3,000 a year, meaning that you can make that much profit every year from your stocks and shares or property before any taxes included anyway. Yet, if you're invested for longer periods of time and you build up large holdings of shares or funds that you sell for a large profit, it will impact you. This is why it's wise to start your ISA and continue your ISA early and continue to invest into your ISA at least until you hit that 20,000 allowance. Another advantage over just a standard investment platform is the exemption from tax on bond interest. So if you're investing into bonds via your stocks and shares ISA, this shelter will protect you from the tax man on those bits. Then also the exemption from tax on dividend income. So if you're investing in companies that pay dividends, you'll be able to reap those benefits without having to pay tax on them. As I mentioned at the start of this, your savings aren't actually protected from losses though in the stocks and shares ISA. So if you put money into one, then invest in funds, shares, that's what's called a risk-based investment. It's not savings. So if the things you invest in don't go well, you can actually lose money, perhaps even all of it if you're invested in single stocks and they go to zero. There's no protection whatsoever when that happens. There are some protections under the Financial Services Compensation Scheme, but this only applies if you lose money due to the product provider, as in the ISA provider, of the investment going bust rather than the companies you invest into. Then there is lifetime ISAs. Lifetime ISAs were launched in 2017 to help people save for their first home or for retirement. Yeah, they're a little bit strange in the ISA spectrum, as you can only have 4,000 limit each tax year rather than the 20 in the cash and stocks and shares ISA. There are two different types of lifetime ISAs. There's the cash lifetime ISA and the stocks and shares. They function very similarly to the normal stocks and shares ISAs, but they are limited to the 4,000. So why would anyone want to use one of these, you're asking? That is a good question, and we've got the answer. So you can save the 4,000 lump sum or put cash in when you want. Then the state, as in the government, will add 25% bonus on top each month you've saved something. So if you save 1,000, you'll have 1,250, and if you save the full 4,000 each year, the bonus will take you up to 5,000, and that's before interest or investment growth. There are a few caveats with this though. You can only open one if you're aged 18 to 39. Once you hit your 40th birthday, you can pay in till your 50s, but you won't be able to open a new account except if you transfer to another provider. You can only withdraw cash if you're buying your first home or you're over 60. Withdraw at any other time and you faced a penalty of 25%, so effectively overall loss of about 6%. If you've saved the maximum 4,000 in a lifetime ISA in any tax year and you've got spare cash left, you can still hold one or more of the other types of ISAs that we mentioned, though remember your allowance in those will be limited to 16,000 rather than the full 20. Then we've got innovative finance ISAs. These are relatively new and are really interesting. If you invest in an innovative ISA and the company offering the ISA will use your money to lend to borrowers or business, this is often known as peer-to-peer lending. You get interest for lending your money out. You get your interest back, which is a portion of the interest charged by the borrower for their loan. It's usually not the whole rate, as the ISA provider will take a cut for offering the service. Your interest isn't taxed. You can lend like this without it being an ISA wrapper, but you do open an ISA, meaning any interest you get from the lending money to other people or companies isn't taxed. Bear in mind though, you may lose money if the people that you've lent to can't repay. The fact that you're lending the money means there's a chance that the borrower won't repay. Risks are mitigated through spreading your cash across multiple loans with multiple providers. However, if a lot of borrowers default, it's likely your savings could take a significant hit. And I've seen this happen firsthand, so be careful. Most of these providers, especially the peer-to-peer side, it can take a little bit of time to get your money back as well if you want to withdraw any. You often need to wait until other investments are there to buy the loan off you, so your portion of that loan. This can be quick, especially when times are good on the platform, but if anything goes wrong, it could be months or even years whilst they go through litigation, receivership, etc. And then the last one is the junior ISA. Just like the adult version, it allows you to save tax-free on behalf of a child. You can save or invest for your child or do a bit of both. You can save up to 9,000 a year. This is less than half of the adult allowance, but it's a separate allowance. So on top of your 20,000, you can also put 9,000 into your child's junior ISA. You can divide the annual junior allowance like you can divide the annual junior ISA allowance between a cash junior ISA allowance and a stocks and shares junior ISA allowance. You can put all the cash in stocks or shares, or a mix of the both, or just cash. The children cannot touch this money until they turn 18. So it's held in the child's name, but it's opened and managed by you. The child can take control at the age of 16, but can't take the cash until 18. So at 18, it becomes their cash, not yours. So whilst you might have saved up for their uni funds or their costs or a deposit for the first home, they could decide to blow it on a Lamborghini, and you legally are not able to stop them. And if you've got any questions, do leave a comment, and if you think this can be helpful for anybody that you know, please feel free to share, and thanks for watching.